Somewhere right now, a retiree just checked her account and smiled. $2,000 landed this month. Dividend income. Exactly like the plan promised. And here's the part nobody told her. That same morning the money arrived, her shares got a little cheaper. Not by accident. Not a glitch in the app. A rule. A written, enforced, everyone agreed to it rule. She didn't get richer that morning. She got paid out of her own pocket. And she has no idea because the number in her account went up, and going up feels like winning. Now, I want you to sit with something uncomfortable, because it's the whole reason this video exists. There is an entire industry built on the hope that you never notice the difference between money that grows and money that just moves. You've seen the thumbnails. Invest $10,000, collect $2,000 a month, forever. Sounds like a cheat code. It sounds like the system finally cracked open in your favor. It isn't. And by the end of this, you're going to understand exactly why, the precise mechanical trick written into the rules of the market that makes a dividend feel like a gift when it's closer to a withdrawal. I'm also going to show you two investors. Same $50,000. Same starting line. Same safe strategy everyone recommends. And 10 years later, one of them has tens of thousands of dollars more than the other. Not because one got lucky, because one understood a single word the other never questioned. The word is yield. Let's take it apart. Think about the last time a store gave you cash back. You spent $100, and the card cheerfully told you, you earned $3 back. Earned. As if the store just handed you money for existing. But you know what actually happened? You gave them $100. They gave you back $3. You are $3 poorer than before you walked in, and somehow you feel $3 richer. That's the whole trick. The feeling and the math are pointing in opposite directions. A dividend is the market's version of cashback. The money shows up, the app lights up, a little green number appears, and your brain does what brains do. It files the whole thing under gift. And the entire time, from the first cent to the last, it was your own money moving from one form into another. I'm not saying cashback is worthless, and I'm not saying dividends are worthless. I'm saying the feeling they give you is not evidence of the thing you think it's evidence of. Feeling paid and being richer are two different events that happen to wear the same outfit. Hold on to that image, because I'm going to say this line more than once tonight, and I want it burned into your memory by the time we're done. A dividend isn't a bonus. It's your own money mailed back to you. I read the fine print so you don't have to. Not the guru version, not the thumbnail version. The actual SEC rules, the actual investor education pages, the actual century of historical data from the people who literally own and calculate the index. And what I found over and over is that the confusion here isn't a failure on your part. It isn't because you're bad at money. It's because the confusion is useful to someone, and useful confusions don't get cleared up by accident. So if this video saves even one person from a very expensive, very confidently made misunderstanding, that's the whole job. Hit subscribe if you want more of exactly this, the machine taken apart with nobody trying to sell you the parts. Now let's open it up. Let me walk you through what actually happens on the day a dividend gets paid. Not the story you were told. The mechanics. Because once you see the mechanics, you can never unsee them, and every dividend thumbnail on the internet starts to look a little different. Start with the thing nobody explains. A dividend doesn't come from some outside pot of money. It doesn't come from the company's kindness, or from a magic account labeled shareholder rewards. It comes out of the company itself. Out of the exact same pool of value that your share price represents. This matters, so let it land. The money was already yours before they paid it to you. You owned it as a sliver of the company. Now you own it as cash. That's the entire event. A company announces a dividend. Along with it, they set a date. The market calls it the ex-dividend date. Ugly phrase, I know. Here's what it means in plain language. It's the line in the sand that decides who gets paid. If you own the stock before that date, the dividend is yours. If you buy on that date or after, you don't get it, the seller keeps it. Simple enough. Now, follow the logic with me one step at a time because this is where it gets interesting. If owning the stock the day before the X date entitles you to $1, and owning it the day after does not, then the stock is literally worth $1 less to a buyer the moment that date flips. The dividend right just walked out the door. So a rational buyer will only pay $1 less, which means the price has to drop. Not because anyone's scared, because the thing you're buying is now missing a piece. That's the deduction. And the exchange doesn't leave it to chance. It's built into the rules. Watch what happens to the price. On the ex-dividend date, the stock's price is adjusted down by roughly the exact amount of the dividend. That's not the market panicking. That's not investors fleeing. It is a mechanical adjustment baked into the rules of the exchange itself. Here's the cleanest possible example. A stock is trading at $50. The company pays a $1 dividend. On the ex-dividend date, that stock opens around $49. The dollar didn't appear from nowhere. It came out of the share price and moved into your pocket. You now own a $49 stock and hold $1 in cash. Add it up. 49 plus 1. 50. The exact same 50 you had yesterday. Nothing was created. Something was relocated. That's the trick I promised you at the start. The market takes a dollar out of your left pocket, puts it in your right pocket, and an entire industry calls it income. This isn't a fringe theory. It's not my hot take. It's how the U.S. Securities and Exchange Commission explains it on their own investor education page, in language even they can't dress up. When a company pays a dividend, the value simply shifts from the share price to the cash payment. Your total value on that morning doesn't change. It just moves from one column to another, and I want you to feel how strange that is. Imagine your boss walked up on payday, took $100 out of your wallet, handed you back that same $100, and said, "Great news, you've earned $100. You'd think he'd lost his mind. But swap boss for brokerage app, add a green notification, and suddenly the same non-event feels like a victory. That's not a math problem. That's a psychology problem, and we'll get to it. There's even a detail most people never learn. That dividend you were so happy to receive usually comes with a tax bill. So in a regular taxable account, you can end up in the genuinely absurd position of paying taxes on the privilege of having your own money handed back to you. Sit with that one for a second. Now, I need to be fair because I'm not here to tell you dividends are a scam. They're not. A healthy company paying a sustainable dividend out of real, growing profits is a completely legitimate, even wonderful thing to own. The problem was never the dividend itself. The problem is the story people wrap around it, and the fortune being made selling you that story. Because here's what most people hear: free money, every quarter, on top of my stock. And here's what's actually true: a scheduled transfer of my own equity into cash, which I'll now owe taxes on. Say that second version out loud to a room full of dividend influencers and watch the energy leave the room. Here's how it shows up in your real life. It's the quarter you see dividend received in your app and feel a little jolt of winning, while the line showing your total account value didn't actually climb the way that jolt suggested. The feeling was real. The gain was mostly imaginary. So why doesn't anyone notice? Why is this the most confidently repeated mistake in personal finance? Because your brain refuses to treat all your money the same way. You've done this your entire life. The $20 you found in an old jacket feels different from the $20 you earned. The tax refund feels like a windfall, even though it was your money the government held all year with zero interest. Behavioral economists have a name for this. They call it mental accounting. We sort money into separate buckets in our heads. This pile is income. That pile is savings. This one is fun money. And we treat each bucket by completely different rules, even though every dollar is identical and interchangeable. A dollar of dividend and a dollar of your own capital have precisely the same spending power. Your brain insists they're different animals. And here's the part that isn't your fault because this wiring runs deep. Your brain did not evolve to think about equity value shifting on an ex-dividend date. It evolved to notice things arriving. A dividend arrives. It shows up. It has a number and a date and a little green icon, and every instinct you have is calibrated to treat an arrival as a gain. Meanwhile, the corresponding drop in your share price is invisible. It's diffuse. It's mixed in with the market's normal noise, and nobody sends you a notification that says, "Your shares are now worth $1 less." One side of the ledger screams. The other side whispers. Of course, you only hear the scream. A dividend lands in the bucket labeled income, And once it's in that bucket, your brain stops asking where it came from. It feels earned. It feels separate from your investment. It feels like the stock went off and did a job and came back with a paycheck for you like an employee. But the stock didn't work for you. It just cut off a piece of itself and changed its shape. That's not a statistic on a chart. That's the person one desk over from you, who brags about the dividends rolling in and has genuinely never once checked whether their total wealth is actually growing faster because of them. And this is the exact seam the marketing lives in. When someone sells you $2,000 a month in passive income, they are selling you the bucket, not the math. Notice they never say $2,000 a month of your own capital, converted to taxable cash. That's the same sentence. It just doesn't sell. So they use the word income, and the word does the persuading for them. Your own psychology closes the sale for free before you've done a single calculation. Think about how much easier that makes their job. They don't have to lie to you. They don't have to hide anything. They just have to describe a true event using the one word your brain is pre-wired to misread, and then get out of the way while you convince yourself. You might be thinking, okay, but income is income. If the cash is real and I can spend it, who cares where it came from? Fair objection. Hold that thought because it's exactly the trap that separates the next two people I'm going to show you. Meet Dana and Priya. I'm making them up to illustrate a mechanism, but the mechanism is real and so is the gap it creates. Same age, same job, same $50,000 to invest, same starting line down to the dollar. You've met Dana, by the way. Maybe you've been Dana. She's the one who discovered dividend investing through a video promising financial freedom, felt that jolt of, wait, I could just get paid to own stocks, and went all in on the feeling. There's nothing dumb about it. It's one of the most natural mistakes in all of investing, precisely because it feels so responsible. Dana does what the internet told her to do. She hunts for yield. She scrolls through screeners, sorts the whole list by highest dividend percentage, and builds a portfolio around the biggest yields she can find. 8%, 9%, 11%. The numbers look incredible next to the measly 1 and change percent the overall market pays. Every quarter, cash rolls in, right on schedule, and Dana feels like she cracked a code the suckers never found. The income is real. The dashboard is green. She tells her friends about it. What's not to love? Priya does something that feels almost boring by comparison. Honestly, it feels like less. She ignores the yield column entirely, barely glances at it. She asks a different question, a colder one. Not how much cash will this pay me, but how much will my total wealth actually grow? The share price and the dividends and everything, all combined, over years. That number has a name. It's called total return. It's less exciting to say out loud. It doesn't feel like income. And Priya builds her entire strategy around it anyway, because she cares more about the ending than the feeling along the way. Here's the crucial part, and it's subtle. Dana isn't ignoring total return on purpose. She's not reckless. If you asked her, do you care about your total wealth growing? She'd say, obviously, of course. She just quietly assumes that a high yield and a high total return are the same thing, that the biggest income number must also be the biggest wealth number. It's an easy assumption to make. Feels like common sense. And it is completely expensively wrong. That one hidden assumption, never examined, is the whole ballgame. Let me show you why with a scenario, and I want to be honest about the numbers up front. These are illustrative rates I'm choosing to make the mechanism visible, not a promise of what any real portfolio returns. Nobody can promise you a return. Say Dana's yield-chasing portfolio delivers a total return of around 3% a year, once you account for the reality that many of the highest-yielding stocks are high-yield precisely because their price is struggling. And say Priya's total return portfolio delivers around 9% a year, closer to what a broad basket of stocks has historically produced over long stretches, though again, never guaranteed. Start them both at $50,000. Run it 10 years. Dana's $50,000, growing at roughly 3% a year, becomes about $67,000. Not bad. She got her income the whole way. She feels good. Priya's $50,000, growing at roughly 9% a year, becomes about $118,000. Same starting money, same 10 years, a difference of more than $50,000. That's Priya's entire original investment. Again, appearing out of nothing but a better question. And here's the cruel twist. If you'd asked Dana at any point during those 10 years, she'd have told you her strategy was working. The dividends were landing. The income was real. Every quarter looked like a win. She was measuring the one number that was designed to make her feel successful, and ignoring the one number that actually determined whether she was. She didn't get poorer. She just got left behind, quietly, by someone who never felt as rich along the way. And I want to be precise about what actually went wrong for Dana, because it wasn't laziness and it wasn't stupidity. She optimized. She worked hard at it. She checked her portfolio constantly. She just optimized the wrong number with total discipline. That's the quiet tragedy of the yield trap. It doesn't punish the careless. It punishes the diligent person who was measuring the wrong thing, and it punishes them slowly enough that they feel successful the entire time it's happening. That's the part that stays with me. The yield chaser often feels wealthier than the total return investor for years. Feels it, brags about it, right up until the day they finally put the two account balances side by side and discover that feeling paid and being richer were never, ever the same thing. Now let me give you a real one. Not a made-up Dana. A company you've walked past 1,000 times. Walgreens. Coming into 2024, Walgreens looked like a dividend investor's dream. It had raised or paid its dividend for nearly 50 years. 50 years. That kind of track record earns a stock a special title in dividend circles, an aristocrat. Royalty. The safe, boring, reliable king of the income portfolio. And its yield looked spectacular. Around 7%. For an income investor, 7% on a household name feels like finding a $20 bill on the sidewalk every single day. But here's what that high yield was actually telling you, if you knew how to read it. Remember exactly how yield is built. It's the annual dividend divided by the price. It's a fraction. And a fraction can get bigger in two completely different ways. The top can grow, the company raises the dividend, which is genuinely good news. Or the bottom can shrink. The price collapses, which is genuinely bad news. Same rising yield. Opposite meanings. So when a 7% yield suddenly appears on a famous, decades-old company, you have to ask which one is happening. Did Walgreens suddenly get 7% generous? Or had its stock been quietly falling for a long time, inflating that yield like a balloon? It was the second one. It's almost always the second one. Walgreens' yield wasn't high because the company was thriving. It was high because the stock had been sliding for years, and every slide in price mechanically pushed that yield number higher, making the stock look more and more attractive to income investors at the exact moment it was becoming more and more dangerous. The market was quietly screaming that something was wrong. And the yield number took that scream and translated it into a language that sounded, to a yield chaser, exactly like good news. Then, in January 2024, reality arrived. Walgreens slashed its dividend, cutting the quarterly payout from 48 cents a share down to 25. Nearly cut in half. The 50-year streak, gone. And the investors who'd bought in for that juicy 7%, they got hit from both directions at once. The income they came for got cut, and the stock itself kept falling, down roughly 64% across 2024. That's the dividend trap in one company. You chase the high yield. The high yield was a warning sign, not a reward. And you end up losing the income and the principal simultaneously. There's a phrase for this that income investors learn the hard way. A high yield isn't always a payment. Sometimes it's the market's way of putting a price on risk and daring you to ignore it. Now, I can hear the pushback because it's a good one. Max, dividends have made real money for real people. My grandfather got rich holding dividend stocks. And you're right. So let me be precise because precision is the entire point of this channel. Dividends are not the enemy. Dividends have historically been a massive part of how the market builds wealth. The people who own the S&P 500 index will tell you that since 1926, dividends have contributed roughly a third of the market's total return, with the other two-thirds coming from prices rising. Read that carefully, though, because it proves the exact point I'm making. That wealth came from total return, dividends plus price growth, working together, reinvested over decades. It did not come from chasing the highest yield on a screener and spending the cash. The grandfather who got rich on dividends almost always did two things the yield chaser doesn't. He owned quality companies that also grew, and he reinvested those dividends, buying more shares, letting them compound, instead of treating each payment as a paycheck to consume. So the objection actually lands on my side. It was never dividends bad. Its yield is not the same as return, and confusing the two is what quietly costs people a fortune. There's one more objection I owe you, because it's the sharpest one. Someone's thinking, but I'm retired. I actually need the cash to live on. The income is the entire point for me. And that is completely valid. For you, a reliable dividend can be a real, useful tool for turning a portfolio into a paycheck. But notice even there, the smart version still starts with total return and durability. You want companies that can pay you and survive, not the highest number on the list. A dividend you can spend is a fine goal. A dividend that gets cut the year you retire is a catastrophe. The filter is still quality first, yield second, always. And to the person thinking, fine, I'll just hold quality dividend companies for the long haul and reinvest. Good. Genuinely. That's a completely reasonable, historically proven strategy. Just make sure you chose those companies for their total return and their staying power, not because a number on a screener flattered you for an afternoon. All right, you understand the trick now. Let's talk about what you actually do with it. First, and this is the whole thing, stop looking at yield as your headline number. Look at total return. When you evaluate an investment, ask what your total wealth is likely to do, price and dividends combined, not just how much cash it mails you. Second, treat a suspiciously high yield as a question, not an answer. When you see 9, 10, 12% flashing on a well-known company, do not get excited. Get suspicious. Get curious. Ask the Walgreens question. Is this yield high because the company genuinely raised its payout, or because the price has been quietly bleeding out and the fraction just looks big? Go pull up the 5-year price chart. Takes 30 seconds. If the yield is high because the stock fell off a cliff, that's not a bargain. That's the market pricing in a funeral. One of those situations is an opportunity. The other is a trap wearing an opportunity's clothes, and it is counting on you to only read the yield and never the chart. Third, if you do own dividend stocks and you don't need the cash to live on right now, seriously consider reinvesting the dividends instead of spending them. That's the move that turns a dividend from a sideways shuffle of your own money into actual compounding. The dividend only builds wealth when it buys more ownership. And fourth, reframe the payment itself permanently. When that dividend hits your account, don't let your brain file it under gift. File it under a piece of my investment, converted to cash, which I now get to decide what to do with. That reframe alone will make you a sharper investor than most people who've been doing this for years. None of this is financial advice. I'm not your advisor, and everyone's situation is different. This is about understanding the machine so nobody gets to run it on you. So let's close the loops I opened at the start. That retiree who smiled when the $2,000 landed? Now you know what actually happened that morning. Her shares got cheaper by roughly the same amount. She didn't receive a gift. She received a scheduled transfer of her own money, with a tax bill attached. She's not wrong to own dividend stocks. She's just celebrating the wrong number. And Dana and Priya, same $50,000 apart a decade later? Now you know the one word that separated them. Dana measured yield. Priya measured total return. One number is designed to make you feel rich. The other one is the one that actually makes you rich. They are not the same, and almost nobody stops to check. Here's what I want you to carry out of this video. The market is very good at making a withdrawal feel like a paycheck. Your own brain is its willing accomplice because a bigger number in your account feels like winning even when nothing was won. So remember the line. A dividend isn't a bonus. It's your own money mailed back to you. Sometimes that's fine. Sometimes it's smart. But it is never magic. And the moment you stop treating it like magic, you start seeing the whole board. The people who build real wealth aren't the ones collecting the most income. They're the ones asking the most honest question. Is my total wealth actually growing? Ask that question and you'll never fall for the illusion again. If this changed how you see that number in your account, Do me a favor, drop the word total in the comments, just so I know it landed. Then go watch the video on the compounding threshold next because it's the other half of this exact idea. Make sense of money. I'll see you there.